Hello everybody, this is July 25th, 2024. I'm going to do a special video here on the stock market and why I believe we are in for a significant pullback next year in 2025, probably the first half of 2025. We may see a giant stock market crash. So if you've been paying attention at all, you know that the 10-year, 2-year bond curve, so we're talking US government bonds, is inverted, meaning that the 10-year rate is actually paying less than the 2-year rate, okay, which in a normal functioning economy should not happen. Everybody talks about how the bond curve inversion signals a recession, and yes, that is true, but what no one seems to mention is that the inversion does not signal it. The un-inversion is what actually tends to signal it. So you can see here, this chart down on the bottom, this blue chart, is literally just the 10-year divided by the 2-year bond rate. So if it goes below 0, you can see that green line is my 0 line right there. If it goes below 0, that signals inversion. Okay, this is not healthy, it's not normal. Okay, and by the way, I'm looking at 1988 right now. Okay, this is the Dow Jones Industrial Average. In 1988, we had an inversion of the bond yield. It went underneath the 0 line, kind of chopped around 0 for a while, but the point where the inflection point where it actually began going up again, instead of just going sideways choppy, you can see was right here. And then this is the price of the Dow Jones right here, right? So you can see that entire time it was inverted, it was going up. And then for about 100 days, 113 days afterwards, it also continued up. But then the inversion, 113 days after the inversion ended is when we saw a 22% drop. Okay, from here to here, 22.5% drop. Okay, big market crash. Now, you don't need an inversion to signal a market crash. Okay, obviously, this one right here was not preceded by an inversion. Okay, but the inversion, every time it has happened, does lead to a market crash. Okay, so it's a pretty reliable signal. It's not when the inversion begins. Again, it's when it ends. So here we go. We're moving forward in time. We're now at 2000. Okay, looking at the .com era, right? We have inversion. And again, we were kind of chopping around, but not really inverted until here. We actually went inverted underneath that 0 line. Inversion begins. It didn't go up, but it didn't drop. It just kind of went sideways for a while. Inversion ends right here, December of 2000, right here. And you can see, depending on how you count this, about 70 days later, we had sort of an initial drop, if you want to count that as a drop. But the real big drop started about 150 days later. And then, we had a big bounce, but then it continued downwards. And by the end, it was a 36.64% drop from top to bottom for that .com crash. And at the time, if you remember that time, that was very scary, right? That was a really scary, crazy drop, 36%. It's nuts, okay? And then we get to 2008 here, or rather 2006. You can see 2006 is when it began the inversion, and it chopped around for a while, kind of up and down around that 0 line. But the inflection point where it actually began going up into uninverted territory once again, you can see that was not the top. We kind of chopped for a little bit, actually hit a new high at one point, but 144 days later, that was the top. And then we saw the 54.5% drop that was the 2008-2009 Great Financial Crisis. Which was, again, if you remember that time, incredibly scary. Okay, but obviously since then, everything's recovered, everything's good, right? Yeah, but look where we are. This is May 2022. Bond yield becomes inversion. And if you remember, 2 years ago, May 2022, we had articles coming out. That's the inversion, recession is coming, et cetera, et cetera, et cetera, right? Did we drop? I mean, sort of little baby drop there, but generally we've been on an upward trajectory all during this time. We are not uninverted yet. Okay, this is still inverted, which means when it does uninvert, which it looks like is coming quite soon. If you can zoom in real tight here. Now it hasn't uninverted yet. I'm just guessing when it's going to happen. I don't know exactly when it's going to happen, but if you're a fan of technical analysis, we can put a line here. Check this out. This was our ceiling here. That was our inversion ceiling, and we are through it. And usually when you go through a ceiling, that means it's going to continue going upwards. If you were looking at a price, a chart, for instance, like right here, for instance, is a price ceiling. Okay. Once you're through that price ceiling, yes, it can come back down, but generally it's going to continue upwards then at that point because you've gotten through that heavy resistance, right? So on this chart down here, it's through the resistance. We're poking out through it right now, which means to me, we are likely going to see un-inversion in the very near future. Okay. I don't know exactly when. Sometime in the next couple of months would be my guess, but that is a line I am watching very, very closely, because once it happens, we're going to have somewhere around 100 to 150 days before we see a potentially very large market crash. I don't know why I had that so long. It's actually more like this. Okay. So right there, we're looking at, again, depending on when this happens, maybe Q1 or Q2 of 2024 or 2025 rather. You can hear my baby in the background here. She's helping me out right now, trying to push all the buttons on the keyboard. And she is not happy about this market crash either. Okay, so let's talk logistically. What am I going to do? Well, in order to get ready for a market crash, what do? You have to get rid of all leverage. You do not want to be leveraged at all, right? Because as things start to drop, if you're over leveraged, you're going to start getting margin calls and you're going to have to start covering that. And if you don't have the cash to cover it, you're going to start losing assets. Okay, that is not good. So you want to reduce leverage, right? Once you see this inversion, uninvert, right? You're going to want to start reducing because you're going to have, let's say if it's 100 days, that's about 3 months. If it's 150 days, that's maybe 4 to 5 months, right? So 3 to 5 months is your timeline. You have 3 to 5 months to reduce your leverage. That includes paying down debt. It includes potentially maybe taking some profit on any profitable stock positions, crypto positions, whatever you have. Probably a wise idea. Raise some cash. Cash is good. Cash is king. And cash allows you to buy back in. When everybody else is fearful, that is when you buy, right? So if we see this thing start crashing right here, okay, and we get a nice giant drop down, potentially you're going to start looking to buy in, maybe a 30% drop, 50% drop. Those are good areas to start looking at, right? So that's potentially looking at a drop on the Dow Jones from 40,000 down to 24, mid 20s. It's quite reasonable in my opinion. Potentially even lower. I mean, if we're looking at the big picture on this is actually my red box right here. This is my red danger zone anywhere in here. So I don't think it's going to get up to that high right there, obviously. We're looking more in this 45 to 50,000 range, I think. It's probably going to be the top of this cycle. But we can see a very, very significant drop after that. It could even go down lower. It could be 60%, 70% drop. I don't know at this point in time how deep it's going to be, but it's not going to be fun. Not going to be fun. So anyway, that's what I'm doing. You do obviously whatever makes you comfortable, and take this with a grain of salt. But that is every time we've seen that uninversion happen in the past, we've also seen a giant market correction follow shortly after. So you have been warned, and I hope you all make it through. All right. I'll talk to y'all later.